So hi everyone, welcome to XP Plus podcast for all things in precious metals and blockchain. I am your host today, Wing, for today's topics on stablecoins. Here's to discuss our Lisa Wade, CEO of DigitalX, the world's first publicly listed blockchain company, and David Lightfoot, CEO of Bullion Asset Management. Welcome both Lisa and David. Excited to have you here. So let's begin with a very quick recap on the most recent collapse of Terra. Terra UST is an algorithmic stablecoin backed to the US dollar by using a very complex seesawing mechanism with a related cryptocurrency, Luna. The project quickly raised over $1 billion with Jump Crypto and Free Ares Capital in early 2022. The mass adoption of Terra network quickly caught up to investors' attentions when Anchor Protocol offering over 20% yield return on stablecoin UST. So between the 7th and 11th of May, UST plumped as low as 30 cents, essentially wiping over $11 billion from UST market cap. And this is where the death spiral begins. So my question to you all is, what are the main factors that you think lead to the fall of Terra?
With respect to algo coins, it's always good to sort of take a step back. When I say algo coins, I mean algorithmic-based stable coins. This set of stablecoin carries risks that can be hard to quantify prior to an event like this. There's a lot of math and economic incentives that go on behind the scenes, and it ends up being a classic case of do your own research. Historically, these sorts of algo coins have in the past capitulated, gone through these sorts of death spirals. A notable project, for example, was the one that Mark Cuban was invested in, the Titan project. Now, what was interesting to me about the Terra collapse was how expected it was. I'd had multiple people reach out to me prior to say, look, there's a risk inherent in the incentives of this project. We've seen online that there are people who pointed out the flaws of this project long before we went through this death spiral event. But really, when it comes to algo coins, until they've been tested in that sort of trial and fire sort of, they've gone through the hard yards of moving from a crypto summer into a crypto winter, in which they see their underlying collateral value fall by 90%. And, a special shout out to Dai and the Maker project, because they experienced exactly that. That is the true test of an algo stablecoin. Its success during a bull market, its ability to maintain peg, is not super interesting until it can maintain that peg through a bear market or some, significant market instability. That's where you really see, whether or not their incentives are correctly aligned with the longevity of their projects. And in the case of Luna, it was both foreseeable and, catastrophic to the market.
Yeah, I guess agreeing with all of that, I can probably add a little bit of colour onto the particular example of Luna. We run a crypto fund where we invest in top 20 crypto, and we do deep due diligence on all of the tokens in our universe. We had come under a lot of pressure actually from investors and the like because we didn't own Luna, and so we'd done extensive research, and we had discovered inside of the algorithm what we called a death spiral. And as part of our fund rules and our investment process and our investment rules and principles, we don't invest in anything that has a death spiral as what we call a red flag, which means it's just completely ruled out of the universe. It was very painful when Luna was the talk of the town and, the people sitting behind us were making literally millions of dollars. It almost makes you feel sick when you miss out on opportunities like that on the upside, to be honest with you. And equally, what made us sick was when the death spiral was triggered, and the death spiral was triggered by what we saw as a very well-planned trade, and people call it an attack. It wasn't an attack. We work in finance. Hedge funds are designed to find market inefficiencies, and this was an inefficiency in the algorithm, which was only exploitable under very specific market conditions. And if you look at all the chatter that has come through now, you'll see that from the very early days, but was flagged again in November, that there was this death spiral, and somebody even published on Twitter how to exploit the trade, and that to us is exactly what happened. And if you look at the timing of it. They waited until the market was weak, when there was already nervousness in the market. There was a negative macro, which is really important. This couldn't have happened in a bull market, I don't think. That's just my opinion. And so they waited for like this perfect storm of circumstance in timing. And then the actual trade had to be quite large, because the bigger Luna got, the bigger the trade needed to be. And then they executed this trade on a Saturday night. They triggered the first swap, swapping the UST from the UST into the USDC, which started the downward spiral, and the rest is really history. But inside of that algorithm, it was foreseeable under the right circumstances, believable. Lots of people said it was unbelievable. Over the years in finance, we learn that we have to expect the unexpected, and that's why we call them black swans, and we have to prepare for them. But I don't think that the market was really prepared for this, because it seemed inconceivable. But what we have now, I've said this before, it's the double-edged sword of us having this mainstream moment in the crypto world, in that, a couple of years ago, it was 76% of all hedge funds were trading crypto. Now it's probably more like 100. And the other side of the coin of all of the money flowing in is more sophisticated trading techniques coming into the market, and people with larger trading books in what is still a very small market. And it's very easy when we're in the crypto world to think about how big it was compared to how small it was a few years ago, but it's still a very small market in the grand scheme of the world and hedge funds and how much money they have. And we joke around and say that it took true evil genius to execute that trade. I mean, it was genius that in all my career, because you still have to get approvals for trades that big at hedge funds. Whoever it was obviously planned the trade and was very meticulous, and it was actually genius in the way it was pulled off, and that's why I call it evil genius, because it wasn't very great.
Okay. Well, that's actually pretty interesting. I mean, a lot of the insider information has given, publishing a lot of social medias, and they actually say that this is a market manipulation since it had happened half a year ago, as you were mentioning. I just really wanted to touch base on, because a lot of the investors that you mentioned wasn't really expected this had happened. And do you think this is the sentiment of the market, because we just finished the bull market, through the early 2020 all the way up until the late 2021? What was the market sentiment? Was it the sentiment that actually drive towards this market adoptions?
The sentiment allowed the trade to happen. I think market manipulation, the reason why it bothers me to use that term is nobody manipulated the market. It was in trading and finance, it was fair market play. Market manipulation is people colluding, front-running orders, and it's illegal. I don't believe that what happened was illegal. I believe that's why I call it evil genius. It wasn't great. They didn't do a good thing. Was it ethical? It's not my job to judge people's ethics. Would I do it? No. However, it wasn't market manipulation, because that is, it's illegal. What it was a trade that was executed very well. Manipulating the market is something else altogether. And when we talk about insider trading, I think it's really interesting. We're in such an interesting time in history, because once something's on Twitter, to me, that's open season. So I could almost say to you, the flip side to that argument is that whoever invested in Luna after that tweet was around, yes, it was refuted by Do Kwon. Should he have refuted that? No, he should have said, yes, there is a death spiral in this. Yes, those things could happen, because people were relying on his word. And I think that's why the pushback against him was so powerful, because he actually stood up against that tweet, which was actually stating facts. That tweet could have helped people, and it didn't. It gave another trader an idea. That I don't believe the person that wrote that tweet executed the trade. I believe some smart trader did research because of that tweet. And I think every professional fund manager who manages a crypto portfolio has a fiduciary responsibility to their investors to do that level of research. And that's what we need to expect now that we are having these mainstream moments. We've got to do the work. We can't just invest in crypto because they're in the top 20. They need to be analysed. The fundamentals need to be understood. And I don't believe it's market manipulation for hedge funds to trade in this market. I think it's unfortunately fair game. And I say that with a complete caveat that I dedicated the last half of my career to impact investing. So it doesn't make me feel sick that all of those people lost money. Absolutely. But it's, I don't think I'd call it market manipulation.
Yeah, sure. Thank you for clarifying.
I think the other thing to add there is the actions of those behind Luna as well were preparing for this event. The purpose of bringing in, the billions of dollars worth of Bitcoin to back the peg was specifically to address this kind of issue within their project. So to refute that tweet at the same time as behind the scenes to prepare yourself for an event like this, again, has just done a further disservice in not having transparent information out there and enabling people to arrive at the best decision for themselves.
I wanted to touch base on the fundamental of the different product, the different financial product that we were offering to the investors, because as Liz was saying, that we're going to have to be responsible at the same time, because right now the market has changed. It has changed from the very bull market to the very bear market right now. What is the key differences that you see between an algorithm and other type of stable coin? And what are the value that is so distinguished, and how did that actually impact as an investors?
Well, I love this question. So I'm going to jump in and answer first because not many people agree with my definition of stablecoins. So I'll get in first and feel free to contradict me. I'm very happy with that. But I see that there's different types of stablecoins. So and I break it into 4 quadrants. And this is not including central bank digital currencies. I've got a separate quadrant for those. Don't you worry. But I look at the algos as the stablecoins as 2 sides of the algo. There's air-backed, which is what we have in Luna. The tokens that have been created to keep the token pegged to the US dollar based off a token that didn't exist before. So theoretically, my analyst would say that that's based off air. And then I think that there are algorithmic stablecoins that are based off pools of tokens and assets with real value. And I think that those algorithms absolutely have a place in our lives. They have a place in the future of Web3. And I think, like all things, we're going to have a few problems and people should go in eyes wide open that things go wrong with algorithms. But I think one day we will perfect them and they'll be wonderful. Then I think we have two different types of stable coins that are non-algorithmic. One is crypto-backed or that are pegged to currencies. And then you have probably the best kind, which are like David is going to talk about. So this is my drop to him. Stable coins that are pegged to real world assets that are, interest securities that are currency like, or actually the real currency. And I think that there's a place for the latter two, and the top ones probably don't have so much of a place in the world right now.
Yeah, I agree. I think, with the key difference, and I sort of look at this from a perspective of algo-based in the sense that it relies on code and crypto economics. So you're relying on the rational incentives of market participants in order to back the token. But the psychology of human beings is complicated at best. So if there's a flaw in your design with respect to your assumptions on how people are going to interact with the project and being rational maximizers, if there is a flaw, they're going to exploit it. The consequences can be catastrophic, as we've seen. Now, I did mention this before, until these projects have been battle tested, as in they've got the underlying collateral has depreciated by 90%, which is not unusual in the digital asset space. I think there's a lot of questions over whether or not you can rely upon the stability of these so-called algorithmic stable coins. Now, when it comes to the other basket of stable coins, at least in the way I see it, it essentially is acting as a bridge between, the benefits of the decentralized world, borderless transactions, sovereignty with respect to your wallets, those sorts of things, and the traditional world. So things like, for example, gold, 5,000 years of history with respect to its value in the world. You can bridge that with the use of these sorts of technologies, but there are a lot of important elements to this. So one is legal recourse, to have a token which represents a legal contract that entitles those with the token to claim the underlying asset. In that way, you always have that fallback option. You can always claim the underlying assets, and thereby that stability is realized. There are other elements too, and there are questions with respect to this in the market. So transparency, for example, is super important. I mean, this whole space was built on trust but verify. So to have transparency with respect to the assets, audit reports, have reputable auditors on board are all elements from, and lessons learned over, the many hundreds of years leading up to, best practices for business that can still be adopted by Web3. Now, with respect to our solutions as well, I mean, the protection of the underlying with respect to vaulting is important. The market partners for supply and demand dynamics in order to maintain liquidity for the token, insurance of the underlying, all these elements play into the peace of mind that you can have as a token holder. But the one that, I think is most important is, that sort of legal recourse at the end of the day. What happens in a moment where something like Terra, and, the other element to Terra is that it wasn't just the structure of their tokens that caused this, but it was everything else that sort of played in the background. So you had Anchor, you had magic internet money, you had, the misaligned incentives between those voting on the direction of the project against, short-term interests outweighing long-term protection. That there were a lot of elements that just amplified the risk of these sorts of projects, which then amplifies the need to have, peace of mind with respect to the stability of your assets. So I highly recommend taking a look at, if nothing else, the transparency element with respect to what's backing your assets and the legal element with respect to what's your claim on those assets.
Yeah, okay, understood. It's actually pretty interesting to see the mixed collateralization of UST and obviously other stable coins such as USDC, USDT. What are your opinions on all these mixed collateralizations? Do you think they are the good sound instrument, or what is your perspective on those different types of coins?
I should let David go first this time.
Sure.
Look, when it comes to me, I'm very simple. I like to understand things before I, invest in them. I like to understand what's backing these sorts of things. So the more complexity that you introduce into these sorts of systems, the more nervous I'm going to be. If you have multi-assets backing one particular token, well, I'm going to need to start to understand the balancing of those assets. I need to understand in what weights. I need to understand, how they come in and out of being collateralized. I think with respect to USDC, USDT, the key point of differentiation there has, to me, always been the transparency element. When we started, there was a lot of noise around the impending Tether bomb. I don't think that's ever really been put to rest. I mean, we saw Tether break peg after UST. But I think the best way to attack those issues is head on. Here's all the assets that back our token. Here's our reputable auditor that you can, take a look at their word and the work that they've done. They're not going to risk their entire reputation. You have the legal recourse as well, which is super important. In which jurisdiction are you claiming? What's the fallback with respect to your assets? But I think Lisa has better insights into this than I do.
Look, to me, I think it's great to have, like, the first time I ever saw a stablecoin I had the privilege of seeing like an underlying portfolio like that, which I signed an NDA, so I can't really say which one, in a previous life. I thought it was really brilliant, and it gave me an epiphany on the future and how Web3 will become mainstream. To me, that was like my mainstream moment. I was like, oh, I get it now, like in a whole new way, like that I didn't understand before, of how financial institutions and how mums and dads can be safely entered into Web3. And I think I totally agree that it just gets, the more new crypto assets you have in there in this volatility, the messier it is, especially when you're claiming to be pegged to a currency that is almost impossible to peg to if you have a dramatic divergence of performance. And so I think we're saying the same thing in a different way. And so I think for now, we need to have stables that are asset backed by underlying collateral that matches the thing that we're being pegged to. Otherwise, you create arbitrage opportunities. I don't know why we're calling it hacks in crypto when someone arbitrages something. That's just fair game. I mean, I'm an impact investor, and I started my career as an arbitrage trader. Buying and selling the SPY index and baskets of Australian equities. And I'll tell you what we used to do to the market. We'd be on the front page of the paper these days. So I just think that right now, I think that until that there is this world in which you can buy a pool of crypto assets that genuinely could replicate the underlying that we're claiming, then I think they need to be closer aligned. But I think it's a journey that we will take, that these different types of stable coins will exist. And then, like David said, do your research. Is it fit for purpose? Because just because it says it mimics the Aussie dollar or the US dollar doesn't mean it has to. It will reflect the underlying asset, the value of the underlying portfolio. It will, because that's finance, because arbitrage does exist. So make it fit for purpose. And in my humble opinion, we do not want mums and dads getting taken out by these volatile stable coins that are driven by algos. They're not stable. They should be called algorithmic volatility products. And call a stable coin a stable. And to me, it's a definitional thing and a labeling thing. And certainly, without giving a plug to XAUD, but DigitalX, as part of our mission, we want to make Web3 better. We want to make Web3 bigger. And so we do have part of our balance sheet in a stable coin called XAUD. And we run a business that is a funds management business. We don't ever manage that portfolio ourselves. We give it to the professionals who know how to manage 90-day bank bills and keep that stable coin stable, because we invest in crypto. And if I thought that I could replicate that investing in crypto, we'd manage the portfolio. But right now, we don't have that capability. So we leave that in the hands of the people that know how to do that. And we support that stable coin because I believe it will actually be the on-ramp for all of our customers into Web3 in so many different ways that's what we're choosing to do.
Yeah, that's great. It's actually pretty unique to hear the both of your perspective on different, it's almost like a personal choice when it comes to stablecoin. Let's go back to Luna. The Terra network has decided to fork a new chain. And what are your perspective on the future of Luna 2.0 and its current ecosystem? Because what I've heard online is that they started different type of collateralizations. Do you think this is the right way to do? What are your thoughts on it?
So I'm going to jump in first so we can finish on a high, because I'm not going to be positive right now. So firstly, you had an interesting comment there. You said personal choice. I believe that stable coins need to be labelled properly so that it is a choice. I don't believe that mums and dads understood UST was not going to behave like a US dollar. I think they believed they were getting high interest rates and a US dollar investment. I believe that's mislabeling, and it's not anybody's fault. It's just there's no regulation. We all know we need to do our own research, but there was a lot of euphoria and a lot of hype, and a lot of people didn't. And, I think that needs to be cleaned up. The definitions need to be changed. As for the Luna fork, I think that it's, I don't like to say bad things. Let me choose my words very carefully here. I hope that it gives some people some money back. I think that we have bankruptcy provisions for a reason, because if you're an entrepreneur and your company went bankrupt, you wouldn't be able to dust yourself back off and take money from people again. There's a reason why companies that lose people's money, it's a reason why those leaders get sidelined for 7 years, so they can think about what they did. And, they don't get taken out of the game forever, but I do think there should be some kind of repercussions for taking that many people out of the game. I know people that lost millions. I don't like it that then they get to dust themselves off and reboot. Anybody who's anybody in crypto has been done by a rug pull, and it's all about portfolio construction. But certainly when I get done by a rug pull, I never look at it again, and I certainly won't ever be looking at Luna or any of its derivatives credibly. And what I do want to say is that there is an opportunity out there right now for another death spiral, and that token is sitting, last time I checked, at 13.7 billion inside of the top 20 with exact same code as Luna. It is cut and paste, and people are piling into it, and it's happening again. They've got a few different bells and whistles, but the same death spiral still exists, and some hedge fund's going to come along and it's going to happen again. And it's not my job to trash talk somebody else's initiative or project, so I'm not going to name it, but it deeply concerns me that we're still mislabeling things stablecoins when they're not stable.
Yeah, I think, just to touch on the personal choice element, I think, people still need to understand that crypto is a very young industry. There's very little regulation around this space. That is both a positive and a negative, though. When it comes to investing, high-risk investments are typically, sectioned off for wholesale or accredited investors. I think, in crypto, it's very much the Wild West. You have the ability to raise capital from basically anyone, and you have the ability to invest in basically anything. But with that comes great risk. And you really need to understand the projects that you're investing in. You need to take what people are telling you with a grain of salt. Just because someone says that, this is the next hottest thing, until you've taken a deep dive and have arrived at your own conclusions, there's an awful lot of tribalism in this space. So I would just hazard that, someone who's telling you to invest in something probably already owns it, and they would directly benefit from its price appreciation. So with respect to what's the perspective on the future of Luna, look, I'm very much the same as Lisa. You don't get two chances with me. If you've proven yourself to fail already, the fork, whatever they're going to do. I'm also with Lisa. I hope that, some people can get some money back. It seems like, they've only got one direction from here. It's very difficult to go further past, basically zero. But will I be anywhere near that project? Not a chance.
Interesting news is that a lot of centralized exchange has actually decided to list, and a lot of partner projects have decided to stand up, obviously support Do Kwon for his Luna 2.0. Really wanted to touch base on that, because with the whole crypto industry, where all the partnerships are going in, the relationship that is going behind the scene is crazy and it's incredible. So the market has just lost over $50 billion. And from the sounds of it, both of you guys are not really too optimistic about, this Luna 2.0. And it looks like it's just, adding up to another potential explode. So what are the underlying issues as a wholesaler and retail investors should be what are the things that they should be aware of?
Look, I'll jump into this one. I think that my guiding principle to investments, and obviously we'll have a disclaimer at the start of this that nothing we're talking about should be relied upon as investment information, but you need to understand the incentives at play. So when, there are exchanges that are listing, Luna 2.0, well, there's a lot of people with tokens on those platforms that are going to be converted into that. The trading volumes on Luna have been absolutely insane, even after it's gone to damn near zero. So there's a lot of incentive for those guys to promote those sorts of tokens, that sort of trading, that sort of volume. They basically get paid for doing so. But with respect to more of a broader view of what's sort of happening in the market, I think people sort of need to take a step back and start to understand that the environment that we're in at the moment is very different to the recent environment that we've gone through. And what I mean by that is the world has more or less changed. And that's because, we had a lockdown response with respect to the COVID situation. We saw extraordinary levels of money printing. That money printing has led to extraordinary levels of inflation, which means that we're now in an environment that hasn't existed for between 80 to about 40 years, depending on which numbers you use. That sort of changed everything. So at this point, we're now seeing supply chain disruption leading to inefficiencies with respect to business. We're seeing equity markets starting to capitulate. One of the things that I think a lot of people misunderstand with respect to the digital asset space, the crypto space, is that its valuations are very correlated to outsized movements in the NASDAQ. Now, if we take a step back and we think about why is that happening, well, the NASDAQ mostly made up of tech stock. When you're in an optimal, efficient environment, people look towards the future. They think, okay, what was the impact of this going to be? With respect to crypto, I've always described its valuation as very similar to the discovery of oil. There was this moment in which, okay, we're using a lot of whale oil for, X, Y, Z, but, we've discovered this stuff within the earth and we need to value that. We need to understand what its future impact is going to be. Crypto, to me, fits perfectly in, that sort of tech valuations, that looking towards the future. When you're going through an environment that we haven't gone through for, 40 years plus, you need to start looking in different case studies with respect to what are we about to go through? Because when things start getting tight, when you start to look at, the potential for recessions, even depressions, then you need to take a step back and say, okay, in what environment does the future tech value premium, what does that future tech premium look like in that environment? To me, I have seen a lot of people point to the fact that, gold's correlated to Bitcoin and Bitcoin's correlated to the NASDAQ, and now gold's correlated to the NASDAQ. I was like, well, that's fine. And it has been over a period in which things were relatively efficient. We had an awful lot of money printing, pushed up all markets. We sort of had an everything bubble. So everything's basically correlated. But if you think that when things start getting tight, that the NASDAQ's going to be correlated to gold, I think you're going to be in for a very rough time. So you need to understand what the fundamental driving forces of these sorts of assets are. What are the incentives to hold these sorts of assets? And in what time period is this most relevant? So if there was one takeaway from what I've just been rambling on about, I highly recommend that people sort of take a step back and think about, okay, well, what happened in history that mimics what's happening now? I think if there's one book I could point to, I think Ray Dalio's Changing World Order is probably the most important book that's going around at the moment, because it at least provides you a framework of understanding the world in different time periods. And when you start to do that, you start to see a lot of patterns. History doesn't repeat, but often rhymes. And there's a lot of things that are happening now that haven't happened for 30 to 100 years or so. But we take a step back and we start to look at things from that angle, I think you're going to be, at least in a better place to understand what's happening.
Thank you, David. What about Lisa? What is your thought on that?
That's a hard act to follow. I think it'd be hard not to echo what David has just said. I think on his comments on the correlation, I think that is a function of people understand markets, they understand fundamentals. It's really important in these times to understand trading and traders and books and herd mentality. And, more than likely, you've got large amounts of money coming to crypto that are managed by the same people that manage large amounts of money in NASDAQ, because they are both highly risky assets and sort of fundamentally based in technology. So agreed there. So I think that, the correlation probably will continue. And I just think that over time, crypto will prove itself to be a legitimate asset class in its own right. People will start to value tokens for the fundamentals that underlie them. And I think, again, it comes to regulation. I think that tokens need to be regulated as they are and as they are not. And, we saw Binance get taken down today, similar to what Ripple has been for, securities tokens. And then what is the difference between a securities token and a NASDAQ listing? It's just a different platform to list the same thing. But one of the true game changers for tokenization, if you start going there in regulation, is the ability for companies that are raising money to raise money in different parts of what we call the capital stack in a different way. And I think that it gives more flexibility for corporate treasurers to raise money. So I think you'll see that's where crypto will really hit its strides, because it'll be able to offer different types of debt products and different types of leverage, combining DeFi and wrapping them into securities. And right now, I can't see, I like what David said about history and cycles and everything. And, we're in a bear market, things go down. Every piece of news is read negatively, things go down again. You can't pick the bottom. All you can do is work out your levels if you're a long-term believer. And I think that, they say in bear markets, build. And that applies to your portfolio as well. We have some famous people being against crypto. But one thing I will remind you of is Warren Buffett was also negative about derivatives. And he sold the largest put in the history of mankind in the middle of the GFC and gamed the whole market. So who knows what he's doing in crypto.
Yeah, both of you guys actually touched based on quite a few different things. So David probably touched base on what are the historical changes, and that will potentially reflect on how we look at the financial market in the future. And where Lisa actually focus a little bit more on the regulation side, and obviously how the whole macro environment will be affecting the decision making from the wholesaler and the retail investors. So I wanted to touch base. The last question that I have for you guys is, what are the advice or maybe key points that you have in protecting the investors' wealth and the expectation management?
Well, I don't think I'm qualified to give advice, although we run a fund that's a wholesale fund. And what I would say to investors is find a safe pair of hands. And if you feel that you are the safe pair of hands, then I think you need to we need to use Patabi Joyce's great quote. He was not a finance person, but he says, do the work, all is coming. I'm a long-term believer in crypto and the value it can bring to the world. I think Web3 is the future. Do the work, all is coming. That's it.
What about David?
Yeah, I think, what's that sort of changing macro environment that we're going into at the moment with, extraordinarily high levels of inflation. I think people are going to have to start to understand what protecting purchasing power means. They're going to have to demand certain elements with respect to their assets. Whether or not that's investing in something that's considered an inflation hedge, or if it's, demanding a higher interest rate from your providers, there are certain things that you're going to have to do in order to maintain the purchasing power of your dollar. I typically don't like making absolutes with respect to what people's decisions should be. I tend to think of it more from, I guess, a psychology point of view with respect to, what allows you to sleep at night. There are plenty of people that I've spoken to with respect to their digital asset holdings that had made extraordinary amounts of money. A lot of these guys, were looking at retirement rather than, ever having to work again. But you point out certain things like how are you going to feel if, the crypto does what it did in 2017. Can you weather that sort of a price change? What I think is helpful is to have an allocation with respect to your assets that you're not freaking out if there's a particular move in one asset over another. I found that worked for me. I don't think it may not work for you. But keeping on the trend of recommending books to read, one of the ones that I read recently that easily one of the best books I've ever read on money was Psychology of Money, and it was just a series of relatively short ideas and pointing out people's experiences with money, but it does give you a framework of understanding what it can do for you, especially with respect to wealth and what that means. And think about what your immediate goals are with respect to those funds as well, or that wealth. But I couldn't recommend that book more highly. And I think, reading it at a time like this is going to be exceptionally valuable.
Yes, definitely. I actually just finished a book over my birthday 2 weeks ago. So I finished the book and I was like, it really opened up my eyes. So thank you, David, for recommending the book to our audiences. Yeah, so you talked about the psychology of money and psychology of wealth. In terms of protecting investors, a lot of people are having their own voices, right? Do you think from an institutional or maybe from a project or a company point of view, do you think it's also our responsibility to educate the users, for example, having a decent enough educational content? What are the things that you think we should do a little bit better to prevent things from something like that from Terra happening again?
I think, with respect to Terra, the important thing was, and the whole space is, you really have to do your own research. It's the Wild West out there. With these sorts of emerging markets, there's extraordinary levels of opportunity. I agree with Lisa that I think the impact of this sector is going to be phenomenal with respect to the value it delivers, but I do really like that discovery of oil analogy. We know that this is going to have a big impact, but what that impact is going to be is yet to be determined, and to what scale. So with respect to what can we do better? I think education is always the most important thing. I'm far more in favor of empowering people with respect to their understanding than to close off opportunities to particular individuals or entities through regulation. I prefer the Wild West approach, but I can understand how that could be unpalatable to policymakers. But that's just my personal sort of view on the space.
Oh, you've kind of poked the bear by using the oil analogy because, what a great example, right? Because we discovered oil, it's destroyed the planet. We discovered oil, it made the planet what it is today. We discovered oil, we regulated oil, we paid people to dig oil out of the ground, and we gave anti-subsidies for people who competed against oil. So I think it's a very interesting analogy. And I think that as humans and the rate at which technology is going to innovate, the faster we regulate crypto, the faster people will find something else. And I hope with all of my heart that we can use crypto and Web3 for good, and to remove layers of transactions costs out of finance, to bring greater transparency, to bring trust in financial transactions via data and via validation and verification. I really hope that we can do good by projects like tokenizing carbon, and a passion of mine right now is tokenizing impact. And if you haven't heard of it, it's because we're just doing the very early work on it now. But I really hope that we can do a lot of good in the world, bearing in mind that equal good, equal bad, and wherever there are humans, there is equal good, equal bad. It's kind of the law of nature. And so I hope that we can do a lot of good. And I think that, that not all crypto is created equal, never has been, never will be. And it just goes right back to what I said earlier, do the work.
This has actually been a very informative conversation. Where could people learn more about you? From the website, from LinkedIn, where could people actually learn more about each of you guys?
Look, I think probably best to just go to xbullion.io. So David, the CEO of xBullion, we tokenize gold, silver, focused on bringing efficiencies to commodities markets, heavily involved in the XAUD project. I think xBullion's your one-stop shop for getting additional information.
Thank you, David. What about you, Lisa?
Awesome. Yeah, well, we're DigitalX, and so you can find us at www.digitalx.com. We're a big believer in xBullion, and we do run some financial products that invest in crypto. They're wholesale funds, though, so that you can go to our website for information only unless you're a wholesale investor. I'm on LinkedIn, always happy to chat to people and point them in the right direction in this space for Web3 to be a true success. We're all better together. The more good people that come into it and create that transparency we talked about, the better. So I think I can see David nodding. So hit both of us up on LinkedIn and we're always happy to help.
Yeah, sure. Thank you. Perfect. Well, thank you both so much. And it has been such a pleasure to have you guys on XP Plus Report. Thank you.
Thank you.
Great. Thanks, Wayne. Thanks, Lisa.